Hi, welcome back to Solution in YouTube channel. In today's video we will learn about the dividend yield. The dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. The dividend yield is an estimate of the dividend-only return of a stock investment. Assuming the dividend is not raised or lowered, the yield will rise when the price of the stock falls. And conversely, it will fall when the price of the stock rises. Because dividend yields change relative to the stock price, it can often look unusually high for stocks that are falling in value quickly. New companies that are relatively small, but still growing quickly, may pay a lower average dividend than mature companies in the same sectors. In general, mature companies that aren't growing very quickly pay the highest dividend yields. Consumer non-cyclical stocks that market staple items or utilities are examples of entire sectors that pay the highest average yield. For example, as of June 2021, Qualcomm Incorporated, an established telecommunications equipment manufacturer, had a trailing 12 months dividend of $2.63. Using its current price of $144.41 on August 17, 2021, its dividend yield would be 1.82%. Meanwhile, Square, Incorporation, a relatively newer mobile payments processor, pays no dividends at all. The dividend yield can be calculated from the last full year's financial report. This is acceptable during the first few months after the company has released its annual report. However, the longer it has been since the annual report, the less relevant that data is for investors. Alternatively, investors can also add the last 4 quarters of dividends, which captures the trailing 12 months of dividend data. Using a trailing dividend number is acceptable, but it can make the yield too high or too low if the dividend has recently been cut or raised. Because dividends are paid quarterly, many investors will take the last quarterly dividend, multiply it by 4, and use the product as the annual dividend for the yield calculation. This approach will reflect any recent changes in the dividend, but not all companies pay an even quarterly dividend. Some firms, especially outside the U.S., pay a small quarterly dividend with a large annual dividend. If the dividend calculation is performed after the large dividend distribution, it will give an inflated yield. Finally, some companies pay a dividend more frequently than quarterly. A monthly dividend could result in a dividend yield calculation that is too low. When deciding how to calculate the dividend yield, an investor should look at the history of dividend payments to decide which method will give the most accurate results. Historical evidence suggests that a focus on dividends may amplify returns rather than slow them down. For example, according to analysts, since 1970, 84% of the total returns from the Standard & Poor's 500 are from dividends. This assumption is based on the fact that investors are likely to reinvest their dividends back into the Standard & Poor's 500, which then compounds their ability to earn more dividends in the future. For example, suppose an investor buys $10,000 worth of a stock with a dividend yield of 4% at a rate of a $100 share price. This investor owns 100 shares that all pay a dividend of $4 per share will give the total dividend of $4 multiplied by 100 shares giving us $400. Assume that the investor uses the $400 in dividends to purchase 4 more shares. The price would be adjusted on the ex-dividend date by $4 per share to $96 per share. Reinvesting would purchase 4.16 shares. Dividend reinvestment programs allow for fractional share purchases. If nothing else changes, the next year the investor will have 104.16 shares worth $10,416. This amount can be reinvested into more shares once a dividend is declared, thus compounding gains like a savings account. If you have understood the concept, give this video a like and subscribe for more lectures. If you don't understand anything related to this video, please ask us in comments.